Into an analysis report, the number Wall Street missed, BBAI's surprise profitability, which looks at Big Bear AI's unexpected Q3 results, specifically that headline-grabbing $2.5 million net income.
And that headline is, an undeniable hook. The analysis makes a really strong case that hitting profitability, even just on a technical level, is the holy grail for a small-cap tech company.
It's a huge psychological signal.
It is. But to really maximize the impact of this report, we need to sharpen the analysis and really strengthen its foundations.
Okay, so it seems like the big theme is this tension between the splashy profit number and the, let's say, the operational reality underneath. So that feels like a good place to start.
Well, the headline number provides an excellent hook. Strengthening the report requires immediate integration of the nuances surrounding how this profitability was achieved.
Right, I see what you're setting up here. The analysis kicks off with that really exciting $2.5 million figure. It has impact. But the context, the really critical context, that this was mostly driven by a $26.1 million non-cash adjustment. That's not mentioned until way later, in Section 4.
Exactly. And that's the weakness. That structural delay, it risks compromising the report's objectivity right from the start. You're giving the reader this big emotional punch without the intellectual context.
So you're saying a sophisticated reader, they're going to see that number and immediately be skeptical.
They're going to be looking for the catch. And if they have to wait 3 sections to find out it's a non-cash derivative adjustment, which is basically a bookkeeping entry, not actual cash, they might feel like the report is, hiding the ball.
That's a huge credibility risk. But if you lead with the operational loss, doesn't that just kill all the momentum and excitement the thesis is built on?
Not necessarily. I think the suggestion here is to reframe it. It's about building trust first. So right after you present that $2.5 million net income, you immediately front-load the distinction.
Okay.
You clarify that the operational reality was still a loss of around, $21.9 million? By disclosing that up front, you build instant credibility. And then you can transition into why the technical profit is still so significant.
That makes sense. You're getting ahead of the skepticism. You're basically telling the reader, yes, we see the operational loss, but here's why the way they achieve this technical profit is the real story.
Exactly. It demonstrates a level of financial engineering skill, which is a strategic positive in its own right. So, for a concrete example, instead of just dropping the net income figure, the report could say something like,
Go on.
Something like, the reality, BigBear.ai posted a positive net income of $2.52 million. Crucially, this was achieved via a $26.1 million non-cash adjustment, meaning the operational loss stood at about $21.9 million.
And then you add the pivot.
Right. However, the sheer size of this technical profitability swing is what institutional algorithms missed, shifting the entire market narrative.
I like that. That phrasing turns what could be seen as a weakness, the non-cash adjustment, into proof of savvy financial management. That's a much more powerful way to frame it.
It is. Okay, so let's move on from the income statement and talk about the balance sheet, that huge pile of cash which the report really highlights.
Yeah, it does a great job of showcasing what it calls the hidden fortress of cash. We're talking $456.6 million in cash and equivalents, maybe up to $715 million in total liquidity.
It's a massive war chest for a company this size.
And then it discusses the big move they made with that capital, the $250 million acquisition of Ask Sage.
Okay, and this brings us to the second critique. The analysis needs to explicitly connect the robust cash position not just as a safety net, but as a strategic competitive differentiator that justifies the cost and impact of the Ask Sage acquisition.
So the weakness here is that the report presents these as two separate good things. Hey, look at all this cash, and hey, look at this cool acquisition.
Exactly. They're presented sequentially, but the analytical synergy between them isn't really explored. It mentions the cash is about 20-25% of the market cap, which is great context, but it doesn't then leverage that point to explain why the acquisition was such a smart, de-risked move.
It's like having two puzzle pieces but not clicking them together.
Right. Think about it this way. If BBAI only had, say, $50 million in cash, how would we view a $250 million deal?
It would be seen as incredibly risky, hugely dilutive to shareholders, a bet-the-company move.
And that's the comparison that's missing here. By not explicitly tying the cash to the M&A decision, the analysis misses a chance to highlight superior strategic execution.
That's a fair point. But is there a risk that focusing too much on their M&A power distracts from their main problem, which is that inconsistent organic growth, the very thing the acquisition is supposed to fix?
I think that's exactly why you have to link them. The suggestion is to use the acquisition cost relative to the cash to show BBAI's unique ability to execute these kinds of deals without diluting shareholders. That's the key competitive advantage.
Ah, so you frame it against their competitors.
Yes. You contrast them with a C3.ai or a SoundHound, companies that might have to go to the market for capital or just couldn't afford a deal like this relative to their burn rate. BBAI's cash allows them to literally buy growth and solve their biggest weakness without hurting existing shareholders. That's a different class of execution.
That is a much sharper angle. It turns a big expense into a strategic masterstroke. So for a concrete example, when the report talks about the $250 million Ask Sage deal, it could frame it more like, like, this deployment of capital represents less than 60% of their liquid war chest, allowing them to instantly address their main weakness, inconsistent revenue growth, by adding around $25 million in ARR while maintaining substantial operational runway.
And then add the competitive point.
Right. This non-dilutive acquisition contrasts sharply with peers struggling to afford similar growth. The term liquid war chest really drives home that sense of strategic power.
Yes, absolutely. That elevates the deal from just being a good move to being strategically de-risked and superior execution. It's much more compelling.
Okay, that makes sense. So let's bring it all home and talk about the final verdict, the investment thesis. The report concludes that the current price, $579, is a mispricing and signals a buy.
And it bases that on, pretty standard technicals. The historical support area, analyst price targets.
Which is fine, but it feels like there's an opportunity for more here.
There is, and that's our final critique. To maximize the report's conviction, the conclusion should move beyond standard technical metrics and offer a more original, deep-seated explanation for why this temporary mispricing exists.
So the weakness is that the current conclusion just calls the recent dip a shakeout. And that feels, well, it feels a bit weak, doesn't it?
It's generic.
Yeah, and it totally fails to connect back to that brilliant insight from the beginning of the report, that algorithms are triggered by this shift to profitability. Why set that up if you're not going to pay it off?
Exactly. We just spent all this time establishing the nuance between the technical profit and the operational reality. Now is the time to use that confusion to explain the investment opportunity. The analysis has to explain why the shakeout is happening, not just that it is.
Okay, so the suggestion is to build a more sophisticated argument. Explain that the dip is probably caused by surface-level algorithms or traders reacting to the price, selling before the nuance of the technical profit versus the operating loss has really been digested by the market.
Precisely. That transforms the entire analysis. It goes from a standard technical recommendation to a much higher-level thesis based on a temporary information gap.
An inefficiency in the market.
Yes. It implies that the reader of this report, the smart money, can move in while the broader automated market is still confused by the very gap complexity we broke down in the first critique. That explains the mispricing so much better than just drawing a support line on a chart.
I really like that. It ties all the analytical threads together. It uses the company's own unique financial reporting from Q3 as the direct reason for the current opportunity. So, for a concrete example, the report could reframe its opportunity section to say something with more depth.
Right. Like what?
Maybe the market's knee-jerk reaction to the dip is likely a shakeout driven by initial profit-taking on the $2.5 million net income headline. This momentary confusion between technical profitability and operational reality at the $5.79 price point presents a specific analytical mispricing opportunity.
That much smart money recognizes as a temporary inefficiency.
Yes.
Before the full impact of the Ask Sage deal closes in late Q4.
That is a much more persuasive and actionable conclusion. It uses the report's own internal logic to justify the buy signal. It gives the reader a reason to feel analytically superior to the rest of the market.
Okay, so to wrap this up, this is a strong analysis report. It correctly identifies some key figures that Wall Street really did miss in BBLI's Q3. We've just highlighted 3 ways to sharpen its impact.
First, integrate that operational nuance right into the core thesis. Don't wait to reveal the $21.9 million operational loss. Use its disclosure immediately in the opening to build credibility before you pivot to the strategic positives. Second, explicitly leverage that cash position as a competitive weapon. frame the $250 million Ask Sage deal not just as a purchase, but as a superior, non-dilutive move made possible by their massive war chest, and contrast that with their competitors.
And finally, elevate the mispricing argument. Give a more sophisticated reason for the current price dip by linking the selling directly to the market's confusion over those technical versus operational profitability figures that the report itself so cleverly dissects.
So the actionable steps for the listener are clear. Revise that opening to address the operational loss upfront. Strengthen the connection between the cash and the acquisition. And deepen the final verdict by tying the price action back to the specific algorithmic triggers discussed earlier.
Do that.